If this person with a nice mustache makes $100,000 a year from their job, well, first thing you gotta do is pay your federal income taxes, $13,800. Then you have to pay your FICA taxes, that's your Social Security and Medicare taxes, that's an additional $7,600. Then you might have to pay state taxes. Let's assume you don't live in a super high tax state like California or New York. Well, now you gotta pay an additional $3,000 or so in taxes on top of that, which means you're gonna be left with about, again, I'm rounding the numbers, about $75,000 after all of your taxes, and now you can spend this $75,000. But what happens now if you do it a little bit differently? What happens now if you earn that money from your stock market investments instead? If you own your investment for longer than a year, this profit that you make is called long-term capital gains, and the long-term capital gains tax rates are very different than the ordinary tax rates you pay when you earn your money from your job. The long-term capital gains tax rates at the time I'm recording this video are 0% on the first $47,000, then 15% up to $519,000. Again, I did round these numbers. And then your top tax rate here is 20% on everything you earn over $519,000. So take a look at this. Here, your bottom tax rate is 10%. Here it's 0%. And here the top tax rate is 37%. Here it is 20%. So now take a look at this. This person with the beautiful braid also made $100,000 a year. This time they made their money from their investment portfolio instead of working a job because they worked to build this investment portfolio. Now, your federal income tax rate is not going to be $13,800 after you factor in the standard deduction. Your federal income taxes are only $5,500. Then when it comes to your FICA taxes, that's your Social Security and Medicare taxes, you paid $7,600 here. Out of your job income, you pay $0 in FICA taxes from your investments because that's what the tax code says. Then when it comes to state taxes, I'm going to be very generous because a lot of states do not charge state taxes on your investment income, and some states charge a lower state tax on your investment income than they do your job income. But let's just say that it's the same. So you got to pay the $3,000 in state income, which means $8,500 in total taxes, which means you are left with $91,000, a little bit more than $91,000, which means yes, you get to keep a lot more money here than here, even though you made the same amount of money just because of how the tax code works. But that's just the beginning. Some people say the IRS rewards you by becoming an investor. Some people say the IRS punishes you for working a job. I don't really care what you call it. I just want you to understand how the tax code works, but this is just the very basics. Let's make it a little bit more spicy so you understand now what you can do to pay even less money in taxes. And I should let you know that for those of you that are investors or want to become investors, my team and I have put together a free investing masterclass where I'll walk you through how you can find investment opportunities before everybody else, and I'll show you how my team and I research investment opportunities, how we do the research, how we find the data to help justify some of our investments. It's a completely free investing masterclass. There's a ton of value in there. All you have to do is register if you'd like to watch it. So if you want to watch this investing masterclass, and as a bonus, we're also going to give you Market Briefs, which is my investing newsletter for investors. If you want to get my investing masterclass and Market Briefs, all you have to do is click the link down in the description below. One way to make this a little bit more spicy is by understanding a concept called tax loss harvesting. Some people on Wall Street love doing this, but the whole idea is, let's assume you invest in stocks and you have one stock, stock A, that is up $2,000 and stock B is down $3,000. Again, we're assuming that you've holded on to these stocks for at least 1 year. If you sold the stock A and you have a $2,000 gain, that's $2,000 of profit that you have to pay taxes on, but you also have this loss right here. If you also now sell stock B for this $3,000 loss, that means now you're going to take this loss and take it against the gain, which means technically you don't have a gain, you have a loss of $1,000. Now, this is where things get interesting because the IRS says that when you make money from stocks, you have to treat that very differently than when you make money from your job because it's different categories of income. So if you have a loss from the stock market, you cannot use your stock market loss to offset your job income. But there's an exception. If it's under $3,000, you can take the stock market loss and offset your active income from your job. In this case, you have a $1,000 loss and you can take this $1,000 loss against your W-2 job income to pay less money in taxes from your job. Now at this point, you might be wondering, well, Jaspreet, if I just sell the stock B at a loss, can't I just do that and then buy the stock B stock back the next day? That way I essentially don't lose anything? Well, no. The IRS does not allow you to do that because if you buy the substantially same stock again within 30 days, they're not going to allow you to take this tax write-off. But if you wait 31 days, then yes, you can absolutely go back and buy the stock B again. But that's not all that you can do in the stock market. Let's talk about 401ks and IRAs. Now, I'm not going to talk about how you can use a 401k or IRA because there's a lot of information out there already. I want to talk about how you can supercharge your IRA. So 401k or IRA are government retirement accounts. What that means is these are government-backed accounts that you can invest money into, and you have the ability to pay less money in taxes as your money is growing. If you have a traditional 401k or IRA, that means you do not pay taxes when the money goes in, but when you pull your money out of a traditional IRA or a traditional 401k, then you're going to pay taxes when you pull the money out. With a Roth IRA or 401k, you're going to pay taxes when the money goes in, but you generally don't have to pay any taxes when the money comes out. So the money gets to grow tax-free inside of the account. The only difference is, do you pay taxes when the money goes in, or do you pay taxes when the money goes out? For a 401k, you generally have to have a 401k through your employer, but I want to talk about the IRA and different ways to potentially supercharge your IRA. A lot of people like the Roth IRA because they say, I don't know what the tax code is going to be like in 20, 30, 40 years, and I don't want that uncertainty. Or maybe I'll have a lot of income when it comes time for you to retire because I'm building a business or have all these investments. So I'd rather just pay the taxes today, not have any uncertainty, let my money grow tax-free, and then pull my money out without having to worry about the taxes in the future. But the problem with the Roth IRA is they have an income limit. They say that you cannot open up a Roth IRA if you make over $150,000 a year as a single filer or $226,000 a year as a married couple filing jointly. So you're out of luck, right? Well, not exactly. This is where you can take a look at a backdoor IRA. The way a backdoor IRA works is you're going to take your after-tax dollars, just like you would for a Roth IRA, but you're going to take these after-tax dollars and then you're going to dump it into a traditional IRA. Once you put it into this traditional IRA, now you're going to convert this into a Roth IRA. So you're essentially kind of just doing what the rule says, which is creating the traditional IRA. You're just going to convert it to a Roth IRA because the tax code says that you can do this, you just can't do that. Strange, I know, but that's what the tax code says. The second concern that many people have is, well, I can only invest $7,000 a year into my IRA. Well, not exactly. If you have a small business, you have a freelancing company, you are a 1099 contractor, there are ways around that rule as well. For those of you that are self-employed, you can qualify to open up a SEP IRA, which says that you can invest up to 25% of your income, up to $69,000 a year in 2025 into this IRA. And it's going to work like a traditional IRA, which means you don't have to pay taxes on the $69,000 of income today, up to $69,000. So if you make $225,000 a year and you want to invest 25% of the $225,000, that's $62,500 that you can put directly into your IRA without paying any taxes on the $62,500 today, because it works kind of like a traditional IRA. So you get to write off $62,500 from your income. This money goes into your IRA, it gets to grow tax-free, and then when you pull the money out, that's when you have to pay tax on it, but it allows you to invest a whole lot more money in taxes because, again, the cap is $69,000 a year. Now, in case you're wondering, could you do this with a Roth version of the SEP IRA? Yes, as of 2023, a Roth version of the SEP IRA was also released. So technically, yes, you could do this exact same thing with the Roth version of this SEP IRA as well. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.